Paxton, do you want to start with an overview? How has the capital market changed in the last 12 months, and how does that affect these dealers out here?
Companies that have been in the business and been in the space for many years. I mean, we come and we speak on these panels every year, and a lot of times you see the same faces. So I think that's certainly a good thing for the industry. That doesn't mean that that as a receivables lender or as a floor plan lender that we're without our tragedies as well. There's been a couple of finance receivables companies that provide lines of credit for dealers that have gone out of business. I think a couple of them have gone out of business in the last 6 months. But the impact from the capital markets, that trickles down, especially into the indirect finance space. I feel like for quite some time, a couple of years, we've been sitting up here talking about, the low cost of money through the securitizations and all the things that are happening there, and that the deep subprime bucket that all of these auto finance companies have started dipping further and further into is going to go away. I think we've certainly seen a number of those auto finance indirect companies that have closed their doors and gone out of business. But we really haven't seen the regression in terms of the opportunities to get a deal bought are still extremely high. I was just having a conversation with Chuck Bonanno 20 minutes ago about how there are finance companies that I'll leave unnamed that will buy here, pay here turndowns. So there's still a lot of availability out there. There's still a lot of indirect subprime, rather they're national or regional, that are buying very deep. But all in all, from a banking perspective, I think things are much tighter today than they were a number of years ago. For a business like Primalend or Spartan, businesses like ours, we have customers that are, I think the quality of credit, the quality of dealer that's knocking on my door today is higher today than it's ever been.
So it's not all bad, it's not all bad news. Who'd like to add their perspective on it? Who wants to talk next?
Well, I'll speak for, there's a lot of stratification that's probably happened. What I looked at with Glenview, you definitely have maybe the main track of where your dealer business was coming from, and what we looked at is what we would consider a good relationship. So we had, how much equity is in the business, what's their working capital, all of the normal things that we would assess. But now, when we're looking at the market as a whole right now from a competition standpoint within our customer base, the actual volume has probably peaked in the business cycle. The dollars per unit financed is remaining constant, and it's probably the highest level of dealers that you're going to have in the market. So from our standpoint, we know that there's going to be a consolidation, and so what we're looking at the dealer level. So what we're looking at is to make sure that every piece of, an underwriting, as we would look at it, it is at the highest quality. We're really not, we're not bending on things like we may have 12 months ago. We're really pushing that solid. The other thing that we've done is created additional programs that would, just the interplay between an advance and control, and you'll see that in specialty finance more than you would with a traditional bank potentially. And so, if there is more risk, then we'll buy that down on advance rate, things of that sort, to make sure that we're in a better position. And I'm seeing that a lot more. There's a lot more alternative programs that may work really well for dealers, but the, if it's not really, the prime credits, are harder to find. There's a lot of competition out there, and we just know that it's going to get a little tougher in the upcoming years. So we're, at least for our company, we're being conservative. We do want growth, but we're also looking at other programs that we can work with dealers on and still protect risk.
Very good, John. Jimmy?
Sure. I mean, what we're seeing is kind of just a tightening of the market. A lot of banks and others are kind of leaving it, and that leads, as we kind of discussed earlier this morning, about finding the right capital partner and people who know the industry and are committed to it. We've been at 8 years, been through the ups and downs, and several of these other lenders have as well. And just find somebody who's committed to the industry as others start to leave it.
Very good. AJ, did you want to add anything to
Just real at a very high level, just the capital markets and where they are today, and strictly from my perspective from a bank, it's become challenging. 5 years ago, we would look at $5 million loan portfolios. Because of the capital out there in the market today, we're kind of getting pushed to, we're only looking at transactions that are, $10 to $12 million outstanding. And of course, that's a product and a reflection of how much capital there is out there and how much we have to deploy.
Understand? Well, so that's kind of sets the table for you, but I'd like you to better understand the targets and the business models that you're looking for as capital providers to the industry. And Jimmy, I'll start with you and talk about the things that are important to qualify for one of your programs and explain a little bit about your program.
Sure. We typically start with looking at portfolio that's roughly 250 to 400 loans in it, and that you've got a reputable DMS. And there's plenty out there, and when we work with several of them are here. I know that you have your policies and procedures in place, and processes, and just who you kind of have in staff with your management team. Do you have an accountant with buy here, pay here experience? Do you have your external accounting with buy here, pay here experience? And then just do you have a compliance program? Because that's become more and more important. I mean, you would think some CFPB with it kind of being changed, but then that may not be as positive as it's going to switch kind of state AGs and who can be, on a smaller grid and be kind of more aggressive. But those are the kind of things we kind of start looking at.
Good, very good. John?
So yeah, we've really maybe changed to a model of show me, don't tell me. Everything when we're going through an evaluation, everything has to be proved out. And it's not in a negative way, just, if somebody's making a representation to us and we're looking through in a compliance program, for example, and, oh yeah, we've got a full compliance program. Okay, well, show me, how are you doing that? Are you using one of the commercial programs that are available? Have you been attending NABD? Are you using, what are the items that you're using? And we're being really selective on that. Compliance is going to continue to be not only an issue with the regulators, but anything that has private right of action and class action suits, having paperwork absolutely uniform. One of the things we look at is the quality of what you're doing on your underwriting. So if we review 200 accounts, what is the quality of that? Are they all exactly uniform, and I can pick up any single one of them and it's going to have the exact same profile, same documentation, same evaluation steps? Or is every single one of these different? And then the answer is, oh, well, so-and-so must have done that deal, not this person. And, because that I just call that static. I mean, that adds risk to a decision. So now on the size of it, we're anywhere, a dealer that's going to be, 500,000 in outstandings, probably up to about 5 million is where we would cap out. And that would be the very much upper end, probably more of around 2.5 million is more of our sweet spot, to answer the question.
Before we move to AJ, I want you to start thinking of questions that you'd like to ask. I know some questions I'd like to ask these guys, but that's not as important as what you need to get answered before you leave here. So please be thinking of your questions. AJ, your perspective on what it takes to qualify and what to do if they're less than 10 million. Should they, do they have to wait to grow into your program and what you're looking for?
Well, I think the answer to that is, what do we look for? We look for seasoned dealers who've been in business for a while, obviously can prepare their own financial statements, have reviewed financial statements, someone who can prepare their own borrowing bases. And obviously, we look to provide modest leverage. We have lower pricing, and with that comes modest leverage. But we also, like to see dealers that actually understand their business and can say, I originate paper with a term of, no greater than 48 months, and this is why. And, my collateral recovery rate is who actually understand where they're going and how they're directing their business. And that comes through seasonality, for being in the business for a number of years. But I think at the end of the day, we all kind of look for the same same metrics.
Okay, Paxton?
For us, I think
Oh, still not,
we're 0 for 2.
still not.
For us, I mean, we're a collateral-based lender, right? So we're going to provide you a revolving line of credit based on the underlying receivables of your business. So first and foremost, the most important thing that we're going to evaluate up front is understanding and evaluating your portfolio. If you call PrimaLend, if you ask PrimaLend, hey, I'm interested in a line of credit, kind of what's the first step? The first step is it's an interview. It's a conversation. We're going to ask you about your business. We're going to ask, talk about the company. How long have you been in business? How many cars are you selling a month? How are you accessing your inventory? How are you marking those cars up? What kind of down payments are you getting? Just try to get a general feel of the business and what it is that, the type of capital that you're going to need based on the plan that you're trying to, kind of lay out for us. The second thing we're going to do is we're going to access your DMS. I can't tell you enough how important it is to properly use your DMS. Technology is a very big, important role that allows you as a dealer to communicate to us as lenders, right? John said, "Don't tell me, show me." Well, how you show us is through data. And so if the information and what you're inputting in your DMS is not accurate, is not consistent, is not done the right way, the same way every time, then it makes it very challenging for us as a lender to ultimately value what, where we see your portfolio fitting in with us. So that's kind of step one. We're going to get a data tape from your DMS. We're going to access that information. We're going to put a bunch of our reporting and analytics together, and then we're going to share it with you, the dealer. Again, we're going to go back to the interview that we had and say, well, Mr. Dealer, you said you buy a car kind of in this range, you mark it up to about this, and this is how you're collecting it, this is your charge off your repos. Well, here's what the data is telling us. So we run through that data with you as an operator, make sure that you kind of get to see the business through our lens and understand how it is that we're looking at your business, what are the metrics and analytics that are important to us. And if they're important to us as a lender, then maybe they should be important to you as operators, right? So we want to share that information with you so that you understand the metrics that we're going to be looking at to measure you as a dealer. And then lastly is, as ownership, we're going to be paying attention to, what type of equity you have in the business, what's your background, want to understand if you're able to produce financial statements. That for PrimaLend, unlike a bank, right, is not necessarily a deal killer. Our job in the market, our niche, is to be a stepping stone to help you get cheaper cost of funding, help you get a loan with AJ that's down the road. So we'll take a little bit more of a risky profile on a dealer, but we're still going to need to understand those things and help educate you along the way to make sure that you do have audited financial statements and profitability so that you can get bank financing in the future. And lastly is compliance. John touched on that. Compliance is going to be a sticking point for any lender, anybody you do business with. So having policies and procedures, having what it is that you do every day written down so that can be reviewed and understood, and most importantly, actually implementing that in your business. We joke all the time, especially from a regulatory perspective, a lot of regulators, they may not necessarily understand your space, they may not necessarily understand your business, but they can read, right? So if you hand them a set of policy and procedures manuals and say, this is what we do, and this is how we collect, this is when we repossess, this is when we charge off, this is when we utilize starter interrupts, whatever it may be, if those aren't the actual procedures that you're following in your business, that's the quickest way to find yourself in a bad way. So making sure that you've got great written policies and procedures, and furthermore, making sure that you're following your own written policies and procedures is very important to us as lenders and ultimately you as owners.
Well, just to kind of recap, make sure I understand, you mean if someone doesn't have a compliance system, doesn't have any metrics, doesn't have any written procedures, but he does have an internally prepared, compiled financial statement, you wouldn't lend him $5 million?
No, sir.
What's wrong with you guys? I think the point I'm trying to make here is we need a little bit more than that. We all appreciate you all have a nice smile, but the reality is, I'm afraid we need just a little higher burden on data to be able to do it. Jimmy, you
Yeah,
want
the
to
comment we make is you wouldn't fly an airplane without a control panel.
Yeah, that's exactly right. Yeah, you wouldn't buy a car at the auction without looking under the hood. You wouldn't fly an airplane without an instrument panel. So why do you try to operate a multi-million-dollar business with no performance metrics or compliance or some of these other things? Just think about that this is big business and it takes big money, and certainly you've got to be prepared to do that. What changes do you see ahead in the capital markets? Is it going to get easier to borrow money? Is it going to get tighter out there? How can these dealers prepare themselves for what's ahead? Who wants to take that first?
I'll take it first. I think it's going to get a little tighter. When I was mentioning the business cycle, I'm looking at 4 to 6 years. It's going to continue to get a little bit tighter as we go. One of the biggest things that my company has done, Paxton was talking about, is data. What are we doing to address, not only who we're going to work with, but who are the dealers that can not be average, right? You want to be above average in your own dealership, in your own business, because you're going to position yourself to take advantage of the business that's going to be out there when there is some kind of a consolidation. Not only having your policies, having your procedures, having your data management system, but understanding why you're doing what you're doing. If you read through your retail installment sales contract and you don't understand all the sections yourself that you're having your customers sign, things that are somewhat rudimentary and basic, you should know. And I would venture to say a lot of you do know that. But it extends on further than that. Why are you getting all of this information? And then how is that being transmitted? That's really going to set you up to have a scalable model in your own business that makes it easy to interact, especially with a specialty finance company. Because we look at everything daily. We interface into your data management systems, and that's very important to us. It mitigates risk, and we can see what's going on. And I think Premalin does the same thing. I'm not sure about Spartan, but it's all of us have gone to these models or are going to these models as lenders, and that should be important to you to make sure that you are ready for that, to put yourself in a really good position.
And speaking of being ready, I think we've got a new accounting credit loss standard coming, and John, I'm going to start with you because I know you know a lot about that, but could you tell us what impact that may have?
So the new credit loss standards, it's a current expected credit loss standard. So you're going to have to, as you originate contracts, you're going to need to recognize up front what the losses are that you expect to have on a portfolio basis. And you're not going to be able to get away with, well, I recognize 12 months of losses up front, things of that sort. And, the industry as a whole did a myriad of different methods, if you will. And typically, and this goes back, I guess, to my public accounting days, if it was consistent from year to year, and you can show that it didn't affect the quality of earnings, then typically as an auditor, I would have been okay with that. And that's pretty much how the accounting firms had handled it previously. Well, now that's not going to be acceptable, and the accounting firms aren't going to get to look at it and say, yeah, management was okay with it. Management being you have told the accounting firm this is an adequate loss reserve. That's not going to be the new standard. The new standard is that the auditors are going to have to recalculate it and understand it and take some responsibility for it. And so, I think Ken might have coined the term "poof, where'd my equity go?" You're going to see if you have audited financial statements and you were setting a loss reserve that was below your life of loan losses, that's all going to come in the year of adoption. And we're all ready for that. Every lender understands that if you're getting financial statements, we do know this. It's a matter of being able to quantify what the change is and changing it one time, because we're not going to want to revisit it a second year after the year of adoption and say, oh, well, actually, our estimates were wrong when we were looking at static pool. This was all hosed up. That would be a very bad position. It puts us in a bad position, you in a bad position. start working on this now. You're probably a little behind the 8 ball if you haven't and you do have audited financials. Make sure that that is rock solid. So when you have the year of change, that's going to affect your balance sheet, immediately. And then and everybody, all the covenants are getting rewritten, everything, to make sure that we're all comfortable with what's going on. But it is a big change. And again, this is a financial reporting requirement. This is not a tax issue. It's not it's not something that's cash out of your pocket, but it is a change in how you look at it. And theoretically, years forward, you should start showing more of the yield on the accounts hitting the income statement after the year of adoption, just because you have a timing difference. But outside of that, it really shouldn't affect you that much as long as you have done your preparation.
I just add 2 things real quickly that the bankers have told me that this is the most significant change in the history of banking, most significant accounting change, and so it's going to affect everybody. That's number 1. Number 2 is that if you go back and you call your CPA and say, hey, look, I heard at the NABD conference that there's a new accounting standard and he doesn't have an answer for you, or isn't familiar with it, you need to change accountants.
Yep.
Because he doesn't understand what it's going to take for you to be successful going forward. I think you've got to recognize that. So he needs to be proactive and help you do it. Now, some of you are out there saying, Ken, I don't need to worry about that. I don't have that requirement in my loan agreement. Mine's based on something different. Well, have you ever tried to sell your business without GAAP accounting? You all need to be aware of what this impact is. It has nothing to do with just borrowing money. It has to do with understanding what your true equity is in your business. So you need to get out ahead of this. Jimmy, what would you like to say?
I was just going to add, you kind of stole a lot of what I was going to say.
Oh, I'm sorry.
But no, it was how we recognize that that's a non-cash transaction, but it just shows the importance of having that accountant with buy here, pay here experience and go ahead and have those conversations with them. And how, a lot of times we see someone who doesn't have an accountant with buy here, pay here experience, and these are the problems you run into when you don't.
We have to raise the bar of financial reporting in this business. It's critical to your success and to the ability to bring more capital into this market.
Yeah,
There's
and Ken,
a lot of questions.
If anybody is curious if your accountant knew about this, go to the last set of audited financials, look in your footnotes, because there should have been a footnote disclosure for at least the past 2 years that a change is coming and that you're evaluating what it is. That should have already been happening. That was already adopted by the public companies and has been going on. And if that's not in there, that'd be a very good indicator to have a very serious discussion.
Yeah, great point. And if any of you are from Canada, I know there's a few people here. The Canadians are implementing that standard earlier. So we as CPAs are watching very closely to the disclosures and how they're applying it as kind of an indicator of what they're doing, because we're still learning ourselves how to apply these new rules. But last question, and then I'm going to turn it over to the audience, is advance rate. I think, a lot of dealers, not all, but a lot of dealers feel that the solution to everything is just get a higher advance rate. If you could get 60, why can't I get 70? Why can't I get 80? Hey, let's do it all. Let's go 100%. So tell me how you feel about advance rates, and is a higher one better than a lower one, and how do you evaluate that?
Advance rates should be a reflection of the credit quality of your portfolio. We personally, because we provide moderate leverage, if you have a CRR, or what we call a collateral recovery rate of, say, 65, we'd look to lend at 55 or 50, leaving a 10 or 15% cushion. And really, what does that mean? From my point of view, it all goes back to advance to cost, and it makes sure that you have some equity in the individual transaction. Having equity in the transaction can only improve you. It's not necessarily a good way to build your business, being fully levered and having no skin in the game. And I mentioned this to Ken before this, and I think everyone should look for a dealer whose lender went away, not specifically, they didn't want to give a loan to them anymore, but just their lender went away, and it happens. And I think Braxton has mentioned some lenders have left the market in the last 6 months or a year, and ask them what happened to them, how did they get through it? And I guarantee you, if they were moderately leveraged, if they had a healthy company, they have no problem finding financing. At a moderate level, I feel it's kind of doing a service to our borrowers by keeping them moderately leveraged. And I'm confident that the borrowers I do have now, if we were to leave the market tomorrow, they would be fine.
Excellent.
But that's a discipline that the dealers have to build in. And it's probably hard to start and grow your portfolio, but eventually you need to have the discipline to get there, to have the reasonable leverage, to grow to where you are and liquidate down and harvest some of that equity.
Great.
Yeah, Ken, I think, a lot of dealers, are standing around the auction and having conversations with other dealers and talking about their lenders and the relationships that they have in the marketplace. And even in the exhibit hall, right, we talk to dealers and they wear their high advance rates like a badge of honor, right? Oh, well, my lender gave me 60% advance rate, or my lender gave me 65% advance rate. And all you've done is tell us that you just have less and less equity in your company, right? Now, there's a tipping point where you need to get enough of an advance that it's not such a negative cash flow hit to the business that allows you to hit the growth expectations and what's available to you in your niche and your market. But ultimately, just as a general term, the lower advance rate that you can afford to live with is the best advance rate. So anytime you're talking to lenders, you're talking to other dealers, just because somebody's willing to give you a higher advance rate, that's not necessarily a good thing. The thing that you should be focused on as a dealer is getting all of the costs you can, as much as you can, of the vehicle, right? The underlying collateral. Using and leveraging your business through one of us as a lender, that's the strategy you want to take. If you're borrowing money from any of us over and above what you're putting into the car, well, now you're paying high interest rates on money you're spending on operational expenses and other things, which is making you less profitable and ultimately devaluing your business and costing you equity. So all in all, the lower advance rate you can survive with, the better.
Anyone else want to add?
I agree with all of that. I have, everything that we look at, we want people to be in a really solid equity position. If they I just call it getting over your skis. They want to get a much higher rate, and we've told some people before, then at some point we're just not the lender for you. And there's a very big difference. One thing I ask people sometimes is, especially in buy here, pay here, do you consider yourself an auto dealer or a finance company? And if you consider yourself an auto dealer because you're buying and selling cars, well, it's a different mentality than if you're considering yourself a finance company. Because a finance company, you're looking at the long-term yield of the contract. And if you're getting out of the cost in the beginning, and you're really keeping that leverage at a manageable level, the long-term play is getting the cash flow over time and making your money out of yield.
Yeah, equity is your friend. It provides your flexibility. It's what you're in business for. So building it is really important. And in over 25 years of working with this business, I've never seen a dealer fail because he had too much equity.
Yeah,
Never.
that doesn't happen. Ken, I'd like to add one thing to that. AJ mentioned collateral recovery rate. Sometimes you'll hear collateral recovery ratio. And a lot of times, especially for us on the panel, these are terms that we use all day, every day, and so we throw them around like candy. But for those of you who may not know, collateral recovery rate is very important to your lender. And the reason for that is, the simplest way you can kind of break it down is, for every dollar of principal that you put on the street, right, for every dollar of amount financed that you create, how many pennies of that dollar over the life of the loan are you ultimately going to put back in your pocket? Okay? And that's what CRR is. And that's a really important number to understand what your profitability long-term is, because you know what you have in the car, right? We call that cash in deal. You know what you're paying for it at the auction. You know what your reconditioning, transportation expenses, GPS, you know all of those costs. But understanding CRR tells you over the life of the loan, am I spinning my wheels or am I actually making a profit? And so understanding the relationship between those numbers is very important to us as lenders because it tells us where we should be from an advanced position. If that principal comes back in a lot of ways, right? We collect principal through principal and interest payments, but as a buy here, pay here dealer, you're obviously repossessing the asset, and then the asset has some value. It can either be reconditioned, restocked, and resold, or it can be wholesaled and taken to the auction. Either way, that's additional principal value to offset some of the charge-off dollars, and you get the benefit of that in the CRR calculation. So understanding those metrics and understanding the value of those to us as lenders and ultimately to you as dealers and managing how profitable you are or can be is really important.
Well, I agree that some of you may not be familiar with CRR, but this morning I was talking about the metrics you need, and I said loss to liquidation. Well, loss to liquidation is the inverse of CRR, and the reason that I like it is it doesn't require you to value the recovery value of the vehicle. All you have to look at is how much of the change in your receivables are you writing off versus how much you collect, and that gives you a percentage. So if your CRR, your collateral recovery rate, is 65%, then your loss to liquidation rate would be the inverse of that, or 35%. So I just wanted to put that into perspective. But I think we've given you a good picture of what these guys do, and now I'd like to get some questions. Does anyone have a question that they would like to ask? Any questions? So we can keep going up here, but I want to make sure that we answer questions. Okay, great, fantastic, good.
Yeah, so I know you guys can't get into specifics, but what are typical interest rates, and what's a good interest rate a dealer should look for when getting a bank? And what is your typical terms on a loan that you guys give out?
Great question.
And typical payments on $1 million, $5 million, loan?
Great question. Go ahead. Who'd like to take that first? Jimmy, you want to start?
Sure. The interest rate with Spartan is typically between LIBOR 10 and LIBOR 14. It's in a range in there, and then the actual payment, it's a revolving line. So I mean, what you're actually paying each, we settle weekly typically, is paying the principal that's paid down or that's charged off. There's not a set, like, amortized amount. It's a revolving line.
So if you're not familiar with where LIBOR is today, what's LIBOR?
It's 2 1/4.
2 1/4. So kind of translates it for you. John?
Our programs, it really depends on how long your, what your weighted average maturity is on what you actually realize. So all of ours is a function of cash flow. So the longer that it's on, it ratchets down on what your effective rate is that you end up paying because it was better paper. The shorter that it stays on, it ends up being more costly. So, but something that stays on for a very long time is probably around 15%.
Okay, very good. AJ?
Our pricing's, in general terms, anywhere from 5.5% to 7.5%, depending on the size of your portfolio, depending on your leverage. I mean, it's very hard to just, without seeing the specifics, understanding, what exactly we could price a deal at. Volume means a lot in the banking industry. You'll have an equal deal with $50 million outstanding. We'll get reduced pricing simply because both transactions, whether you're $3 million or you're $50 million, require the same amount of servicing and backroom costs and so forth. So that's typically our price structure.
Paxton?
We're typically, for a new customer, 13.5 plus LIBOR. Our advance rates are generally going to be predicated on the underlying value of the collateral, right? So we talked earlier about putting together some analytics and some reporting, and we share that back to you as a dealer. And so that's going to tell you where we view your cash and deal based on what's in the DMS. So oftentimes that starts a discussion. Well, I'm not reporting all of my costs, and I don't put my detail and transportation expense on a VIN level detail. So when I extracted the data, it wasn't there. So we go through that exercise and get to the right number. I think here's what's important to understand, because I think a lot of times these numbers scare dealers, right? You hear me say 13.5 plus LIBOR, you're sitting there in your chair thinking, well, man, I'm only charging the consumer 21, 24, whatever it may be in your particular state or business. How do I make any money? Well, remember that you have let's just, for argument's sake, say a $10,000 amount finance contract, right? And you're earning 24% on $10,000. Well, I'm only going to advance you, say 50%. So I give you a $5,000 advance at a all-in cost of funds of 15%. But on the 24% on the 10 grand you're earning, I'm only a net 7% of your interest income. Make sense? So in that example, you've got 17% of positive interest income plus your down payment plus the spread between cash and deal and CRR. So those three categories together kind of give you your gross profitability.
One thing I think we shouldn't overlook is that for the last several years, we've been in a very low interest rate environment, and it's been very stable. Interest rates haven't been raising. That's all changed in 2018. So now we're seeing an escalating interest rate environment. So I'd like to ask you guys, will your cost to the dealer increase if interest rates rise? In other words, are you using a floating rate debt model, and what should dealers be thinking about there?
You want me to start?
Well, whoever wants to take it first. Who wants to take it?
Well, from PrimaLend's perspective, when you're at 13.5 plus LIBOR, we're at the higher end of the spectrum. So we recognize that as my mic dies.
Oh.
I'm like the mic whisperer. I don't know what's going on up here. I've got a graveyard of microphones. Sorry to you in the back. That's on me. As LIBOR continues to rise, in most cases, a lot of dealers are not going to be able to, everything kind of flows downhill, right? So dealers are not going to have the ability, Ken, to continue to increase the rates and the interest that you're charging to the underlying consumers, right? So if you're at 21 or 24% or whatever it may be, you're kind of where you are. So for PrimaLend, really in the last 12 months, we've been looking really hard at how do we change our business model? How do we adjust what we're doing in our business so that as LIBOR and the interest rate environment continues to rise, we have commitments, to our partners and yield expectations that we have. So how do we maintain that, but not continue to pass along every dime of LIBOR and that spread onto the dealer, who then can't continue to pass that down to the consumers? Because our banks, lenders have lenders, right? So our banks, our wholesale line, our warehouse line of credit is tied to LIBOR. So as LIBOR increases, we then turn around and pass that down to the dealer and so on and so forth. But then the dealer doesn't have the ability to turn around and increase the cost to the consumer. So we've looked at a lot of strategies, and some of those are, co-senior relationships with other banks that have a cheaper cost of funds, so that as a dealer, you may be doing business with PrimaLend, but your blended cost of capital is actually at a lower rate than it would be with PrimaLend alone. So there's things that we are looking at. We're certainly sensitive and paying attention to the fact that we're in a rising interest rate environment, and looking for different ways that we can impact that positively for the dealer, but still continue our business model, which for us has been very successful.
Sure. Anyone else want to comment, John?
Yeah. So for us, what we've really looked at, what we're talking about here is the fact that whoever this, as a specialty finance company, it really compresses our margins. Like Paxton said, you guys you can't necessarily raise your rates any higher than they are. A lot of it is you're already governed. Okay. So if you're already at a max interest rate, you're not going to be able to increase your yield. So we understand that. So what we look at is efficiencies that we're able to pick up, and primarily what we've been working on is just through automation and really driving down our cost structure to make sure we accommodate. And that's no different than any other expense that's going to become an increasing fixed expense that anybody has to deal with, and overcoming that as a challenge when the revenue is not going to increase as well. So I think we all are doing that in some fashion or another, but that's how we're addressing it. That's not a cost that we are looking to pass on to dealers.
Okay. Jimmy or AJ?
Ours is very similar. Like when I said that LIBOR is currently about 2.25. 18 months ago, it was 75 basis points. So that's a 150 basis points increase in a year and a half, and that's real money that's gone through there. And so, I mean, we've done very similar things of trying to find efficiencies and automation of how to leverage that, the operating costs that we may have passed on previously. We're trying to find ways to absorb because we realize the impact of that rising interest rate.
Okay, AJ?
Our rates are tied to LIBOR as well, and like any lender, we have to pass that on to the underlying borrower. We're at a smaller structure or lower rate, so it's a little bit easier to absorb. But I think it's fair to say every lender, as LIBOR and prime increase, rates in general are going to increase, and the dealer can't necessarily pass those on.
And I think it's fair to say that you should go back and evaluate how rising interest rates are going to affect your business. Just like we're asking you to look at the credit loss measurement, you need to understand how that's going to affect your cash flow, how it's going to affect your business model, how it's going to affect your business. So that's something to think about regardless of what your lender says he's going to do. This gentleman had a question down here, and I'm sorry to keep you waiting. We want to finish that answer.
It's quite all right. I was curious if you could, in light of talking about the benefits of having equity in the business and not necessarily looking at leveraging, as a means to maybe grow the portfolio, what kind of factors are you guys using, though, to determine what that leverage ratio is appropriate for the
Fair?
lending relationships you're setting up with the dealers?
Yeah, how can you determine if there's too much or too little equity in your business?
Yeah, well, for us, it's certainly a case-by-case basis, and every dealership is the same, right? It's going to depend upon, what kind of collateral, what kind of cars you're buying, how you're marking those cars up, what's a typical down payment look like for you, because all of those things affect ultimately the deal structure, which kind of lead back to cash and deal. For PrimaLend, we don't want to advance one penny over what you have in the car, right? Because as I expressed earlier, any dollar you're borrowing from me, especially at 13.5 plus LIBOR, is an expensive dollar if you don't have the interest income being thrown off as a result of that. So to use a typical example of a deal structure in our space, if you buy a car at the auction for $4,000 and have $1,000 worth of reconditioning, GPS, detail, transportation, all in, you've got $5,000 worth of cost. And you mark that up to say $11,000 and get a $1,000 down payment. Now we all understand TT&L, but just for round numbers purposes, if you have a $10,000 amount finance contract and a $5,000 cost basis in that contract, I'm going to try to advance you 50%. So in that example, you wouldn't have any real equity that you're putting into the deal. But oftentimes we come across dealers that maybe they're buying the higher you go up in the spectrum. In terms of car cost, generally the lower of the markup that's available to you, right? We have dealers in our portfolio that, one in particular that, his ACV is about $15,000 to $16,000. That includes the recycled inventory that comes back. So a lot of times at the auction, he's buying a $19,000, $20,000 vehicle, but his markup is 44%, right? So his cash and deal is well over 70%. But at PrimaLend, we're advancing him 60 cents. So he's putting 15 to 17% equity into every deal that he does. So when you start looking at your model and looking at your business, those are the things that we're going to discuss kind of day one, right? Because we don't want to put you in a situation that isn't going to be successful for you. As a lender, I only succeed when the underlying dealer that I'm doing business with succeeds, right? If you fail, I fail. So we want to make sure that the business model, the cost, the growth expectations, the cash that it throws off, everything works. And if the business model doesn't work, then we either try to find the solution to fix it, or ultimately there may not be a deal for us as your lender.
Great. Anyone else want to add to that?
I would say it also, AJ, go ahead.
I would just say, I agree with everything, Prexton just mentioned. We look at it as advance to cost, right? We don't want anyone, we never want to advance more than what it costs you to originate the vehicle, right? Otherwise, you'd make money just by originating loans, right? From a very high level perspective, we really like a dealer who's levered 2 to 1. We'll tolerate up to 3 to 1 if you understand leverage as it pertains to the balance sheet. Just a very high level to look at it. I'm sure you've heard you don't want to live paycheck to paycheck, and we certainly don't want our borrowers to live borrowing base to borrowing base. It's nice to see a borrower out there who has, $150,000 cash on its balance sheet and, doesn't leverage himself up every month and spending every last dime just because he has it, And that obviously is equity, because he doesn't necessarily need to draw that down. But, those are the types of things. I guess it's tough to grow. I think your question pertained to how do you grow and still maintain the leverage. It's tough. It's a discipline. You have to grow your portfolio, and at some point you have to level it off, and you have to see exactly, how your collateral is going to perform, and you have to harvest that equity. And I think that's what's missing a lot today in the market.
My world is not how many you sell, it's how many you keep sold. That's going to be the answer for you. And I think if you want to build a good portfolio, you better keep them out there and keep them paying for a period of time. I know we're at 4 o'clock, but Ben, we'll take a question from you, but I want to just say, just before you ask, is that we didn't intend to tell you everything about each of these guys or which is best for you. That's why we have an exhibit hall. And we want you to go in there and visit with every one of these guys and figure out what's the best fit for you, and visit with all the other capital providers. In the next session, I'm going to do contract purchasers, so that may be another option for you.